From the transaction analysis we completed, we prepared all of the journal entries and prepared a brief income statement so we can check the operational performance of the company in August. That's pretty much we can offer to the users from the financial accounting side. So transaction results, the impact on the ledgers, the trial balances, and the financial statements. For internal users, such as managers, we can offer the cost reports related to the finished goods or the cost of goods have been sold to customers. So we call cost of goods manufactured and the cost of goods sold. These two reports are only for internal users because they represent the private secrets of the company's cost information to make the products and sell the products. You don't want the public to know this information, including your competitors in the market. So in addition to the cost reports, there are other questions I want to think ahead before we touch on the details in the future chapters. But be careful, I'm not requiring you to fully understand or do the calculations at this point of time. These questions act like a prompt, like opening door thinking questions, so you can push yourself, okay, think beyond the data we provided. What are the information we can offer or analyze from the transaction analysis so we can help the managers to make various important business decisions? For example, number 6, ask further for the overhead allocation. The general manufacture overhead. Remember those depreciations, utility cost, or the supervisors of the factory. All of these expenses are defined and captured by the manufacturer overhead for all of the products and departments involved. How we can find a reasonable allocation base to separate and break down this cost into the products or departments. In this question, I let you know we can use the production volume, means the more units you made, the more overhead they will get. But is this really a reasonable? Because if you choose the production volume, means I'm thinking the volume of the overhead is proportional to the units completed. So the more units you made, the more overhead is related and we allocate to them. But are there any other allocation bases we can consider? For example, will the overhead be more related to the direct labor hours or the amount of the raw material used in the production, or maybe the hours of the running the machineries? So if you have a highly automated production, most of the overhead are related to the machineries, equipments, like is machine hour related. So in chapter 2 and chapter 3, we'll introduce more cost drivers or cost allocation basis for overhead. And then even in chapter 4, we talk about activity-based costing. Those are really critical areas for a company to think and decide, because the way you allocate overhead immediately affect the level of the cost we use in reports and in decision making. If the overhead allocation loses relevance to your actual operations, the cost data won't be accurate. Then your pricing decisions and other decisions based upon the cost will be really misleading rather than give you the correct idea for the future operations. So accuracy and relevance of the cost information is the foundation for all of your other managerial decisions. So those we'll discuss more in chapter 2, 3, 4, and 5. And then number 7, I have a different situation for you to consider. So if the marketing manager, right, so the marketing manager, they propose to increase the marketing advertisement in social media for the leather sofa, so by 5,000 or more, and increasing the advertisement is expected to increase the sales units or the volume by 5%, the leather sofa only. So 5,000 more cost on social media advertisement, 5% estimated increase sales volume. Is this a reasonable proposal can be considered? And this one you couldn't just decide based upon a brief discussion, and you need to really justify your decision by the numbers later. So for example, if I said my sales volume increased 5%, right? So giving the same sales price, so means my sales revenue can increase by 5%. So I'm using the 80 units right now. So by 5% increase, that will be approximate $2,000. But the cost increase, so here is the problem. The cost we have calculated is 43,200. So you can check the transaction before. But will the cost increase matching with the 5%? The cost include direct material, direct labor, and all of the manufacture overhead. The direct material and labor will increase when the volume increase as well by 5%. But not all of the overhead will increase proportionally by the 5%, especially the fixed overhead, such as your rental expenses, depreciation of the equipment. So no matter the sales volume, this part of the overhead will stay the same in this range. So means they won't increase with your sales volume. So how we can find out how much of the production cost will increase? We need to get more information based upon the cost analysis for the overhead. So which are variable, so which will increase proportionally with the sales volume and which will stay the same. Then after that, we can decide how much the cost will increase and then how much the gross profit increase, which is the difference between revenue and cost. Then we can compare the gross profit increase with your advertisement expense. So is this a worthwhile investment? If the gross profit increase larger than the 5,000, that's maybe a viable proposal. Otherwise, probably you can reject it based upon the numeric values only. So that's and for this type of analysis, we call cost, volume, and profit analysis. So we are investigating the interaction of the sales volume, cost, sales price, and the profit. So interaction between the dynamics of the profit-making process will explore more in Chapter 6 under the cost, volume, and profit analysis. And then number 8, a special order situation. So the general manager got number 8 is the variances analysis. Because remember in the beginning, they said the manufacturing industry will normally use standard costing system to help you control and monitor the cost differences. We investigate the actual cost with the standard cost from material, labor, and overhead. So we can see, do we have favorable variances? So means you save the money compared to the standard cost. So actual cost is lower than standard. Or you have unfavorable variances, means the actual cost is higher than the standard cost. So as managerial accountants, how we can perform the cost variances analysis, how we can identify the possible reasons for the variances, such as the usage variance. We used more like volume, like more quantities of the material, like the square feet, or do you have more waste, right? So we have more waste of the materials, or we have inflation of the material pricing over the period, right? So we couldn't control the inflation of the supply chain part. And for labors, you have the labor rate change or usage of the labors, or you use the inefficient labors, new labors that will cost more hours to make the product. So that's all possible reasons to tell you the differences. So how we can nail down and find all of these? So we call standard costing and variances analysis. That's covered in chapter 9. Then question number 9 is a special decision making. You got a special order for the leather sofa for a new customer. They try to order 200 units, but they only can offer a $500 per sofa. And remember, our normal sales price is $680. From the first glance, you think it's impossible I can sell at 500. It's much below my normal price, right? But the additional thinking is, so what's the true cost to make a sofa per unit? From our prior calculation in the transactions, we think it's $540 per unit, including material, labor, and overhead. I don't have any concern about the material and the labor. They are fixed. But again, the problem is from the overhead. Some of the overhead, again, they will change when you accept the special order, because they needed you probably need to pay additional indirect labor, indirect material, and some of the variable overhead, like the variable part of the utility electricity. But some of the overhead you won't change no matter you accept the special order or not, like the depreciation of the machineries or the supervisor's salary. So among these $120 may not be the true cost to make the sofa. So to decide is this 500 pricing acceptable or not, we need to have a more detailed analysis for the overhead. And once we found out, so we break down this 120 and found out the unavoidable unavoidable overhead. So we can add it here to the material and the labor. Then we can compare with the special pricing to see this is reasonable or not. So if the cost, the true cost lower than 500, so we still can accept the order and maybe making a small profit. So special order. Or even sometimes you know you are going to lose money for this special order, but you have some other concerns. I want to build a long-term relationship. To acquire market shares, I still accept for reasons beyond my financial performance that other concerns of the managers. So we call this special order decisions of special pricing. In chapter 11, we talk about a series of decision scenarios related to short-term decision makings using the relevant revenue and cost concepts. So chapter 11. And finally, number 10. From our analysis of the income statement, you already can tell the fabric line of the sofa has been losing money consecutively for a few months. Should we discontinue? Right, like the common sense is I will stop any products is causing financial loss to the company. So we are losing $2,000 for August and probably a few months before. If you stop the fabric line, we can focus on, so use the equipment or resources to focus on the leather sofa. But in that case, you will narrow down the product variety of the customer choices. So except for financial reasons, there are some conditions we need to consider, okay, to keep or stop the fabric. And any possibilities we can reduce the cost, right? So I can reduce the cost to make it and to change the loss maybe to profit in the future, or increase the sales revenue by adding some attractable features to customers. So that's all other concerns except for this simple 2,000 loss. And how the managers can make a right decision. You need to play around the different scenarios. Okay, how about if I reduce the material cost and the labor cost or increase revenue? So we play around, so we call scenario analysis. And that's a big combination we discussed in chapter 10 for performance evaluations or even scenario analysis. Okay. So those are really interesting but critical questions for managers faced on daily basis in any type of organizations, not only for manufacturer. You have similar concerns for merchandisers, service companies, and even not-for-profit organizations. And this information, managerial accounts can chime in and really make significant contributions. So that's like why I use this small case to let us understand better and what's the contents, okay, what kind of the contents we'll discuss and learn during this short period of time, and how those are important and critical, not only for accounting majors, is really for general business in the business field for all of the functional areas, for procurement, sales, marketing, human resources, okay, and let alone for your CEOs.